My first property was a 32 unit building and I made about $4,000 a month. And then my second property was another 30 units and I made about $3,000 a month. And it wasn't until 3 years that I felt that I was making enough money to quit my job.
Welcome to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owner Association, providing benefits and services to real estate investors and rental property owners for over 48 years. With your host, Brian Hamrick from Hamrick Investment Group.
Hello and welcome to episode 58. So I've definitely been looking forward to today's conversation. As you know, I'm primarily a multifamily and apartment investor, so I couldn't be more excited to talk to the number one nationally known educator and mentor for multifamily investing, Mr. Brad Sumrok. Brad specializes in helping people retire in just 3 to 8 short years by investing in apartment complexes. Brad has been a principal in over 3,000 units, and in 2012, he won the prestigious Rental Owner of the Year award from the National Apartment Association. Brad's personal mission is to help as many people as possible obtain more income, freedom, and security by transferring his 15 plus years of experience in apartment investing to those who attend his trainings. And if you are within traveling distance of Grand Rapids, Michigan, you will have the opportunity to hear Brad speak this week at the RPOA annual conference on Saturday, February 25th. Now, the conference is that Thursday, Friday, and Saturday. Brad will be there Saturday, February 25th of 2017. So I want you to stop, pause this podcast right now, and go to rpoaonline.org to register for free. Brad, thanks so much for being on the show today.
Hey, Brian, I'm excited to be here.
You and I are both apartment investors, so I've really been looking forward to talking with you today. Can you start by taking us back to the beginning and tell us how you first became an investor in multifamily and apartments?
Sure. Well, I never thought I would be an apartment investor or a real estate investor. You know, I was raised in Pittsburgh and my dad never finished college, so my parents, taught me to study hard and get good grades and, get a good job. So that's what I did. I studied engineering. I got an MBA. But after 17 years of, the corporate rat race, and I was laid off once and fired once, I actually considered going to law school when I was like in my early 30s, and I'm glad I didn't do that. And I started reading. I read books like Rich Dad, Poor Dad. I learned about ESBI, employee, self-employed, business owner, and investor. And that's what really attracted to me about apartment investing is because, my parents had taught me to be an employee and maybe someday be self-employed. And with apartments, as soon as you buy an apartment building, as little as 5 units or more, you're immediately a business owner and an investor. And so that's kind of how I got started, was transforming my mindset. And then I, obviously went out and learned the how-tos of finding deals and analyzing deals and stuff like that.
Tell us a little bit about transitioning from having a job to, getting into the multifamily and apartments. Were you still working full-time while you were doing this?
Yeah, so I worked for 3 years. And, that's another reason why I did multifamily is because I went to a seminar on single family rental investing, and I learned that you can make $200 to $300 a month positive cash flow per rental house. And I had an income of $10,000 a month. So, I'm thinking, man, I need like 40 houses, just to replace my income, because I learned at that time that retirement for me would be when my investment income meets or exceeds my W-2 or my job income. And so, I thought it would just be a lot easier and more scalable and faster to go out and buy apartment buildings. And so, my first property was a 32 unit building and I made about $4,000 a month from that building. And then my second property was another 30 units and I made about $3,000 a month. So just, with 62 units, I was making like $7,000, $7,500 a month. And, and that took me, 2 years from the time I started. And it wasn't until, after 3 years that I felt that I was making enough money to quit my job. So I always tell people that are starting, don't quit your job and then become an apartment investor. For most people, and now I've helped hundreds of students, with their apartment investments. And most people were able to walk away from a six-figure income within, 5 years or less.
Let's dig into that a little bit with your first couple acquisitions. Are you in the Dallas-Fort Worth area?
Yes, I am. That's where I currently have my business center. But I actually started in Houston, Texas, and that's where my first two properties were.
Okay, Houston, Texas. Do you mind talking a little bit about just the numbers on that first 32 unit?
Yeah, I remember it like it was yesterday because, it was, 2003, and that was 14 years ago. It was just under $1 million. So the price was $994,000. It was currently owned by a guy that specializes in rehab. So he bought it and rehabbed it and made it really nice. And so, for me, it was a great starter property because there wasn't a lot of renovation for me to do. I don't really work with my hands. I don't know how to fix things and all that type of stuff. So I always tell people in my seminars, the only tool I know how to use is a wine bottle opener. So I was not looking to, be Mr. Fix-It and Mr. Handyman. And that's another reason I love apartments. Just think about ESBI. I mean, we're buying apartment businesses. So on that 32 unit building, there was a manager that lived on site. So I didn't have to go to the property and knock on doors and collect rent. We had a part-time maintenance guy. So again, I didn't have to go to the property and, with my tool belt and, fix stuff. So, that's how we staffed the property. I was able to work in my corporate job, and I even traveled internationally 25% of the time, but it was just about $1 million purchase. I put just under 200 down. That money mostly came from my own personal savings because, I worked in the corporate America from 22 until 35, and my parents taught me to save my money and invest for the long term. So I had accumulated throughout my, corporate America, working as an engineer and stuff like that. I had accumulated money, so I did have the down payment money to put that 20% down and got an 80% loan. And like I said, it put like $3,000 to $4,000 a month in my pocket. And I had a manager, I had a maintenance person, so I didn't have to go there and do all the things that, one might have to do, say, with a single family rental where you're self-managing the property.
Now, you had a manager. Was this a third-party professional management company, or did you have an on-site manager?
Yeah, on the 32-unit property, I had a family that lived on site. And the property manager worked for me directly, so it was not a third party. It was me. I set myself up as the property management company, and the property manager worked for me. And she was a stay-at-home mom, so and she had 4 young kids, so she was pretty much at the property, during business hours, and after business hours most of the time. Okay. So that's what I was looking for, somebody that was there, somebody that you can trust. And she was working as the property manager for the previous owner as well. And, a lot of times when you buy a property, you may want to change property managers, but this person turned out to be a good fit for me. And she worked for me for 3.5 years for the whole time that I owned that property. Now, when I went from 32 units to 62 units, then I hired a full-time professional property manager that covered both properties because those properties were, in the same neck of the woods. And that's where I learned about economies of scale. And it was actually easier to run 62 units than 32 because now I had a full-time manager and a full-time maintenance person. And then just, I know you haven't asked yet, Brian, but, my next purchase after that was I syndicated the 250 unit deal. And that's when I went out and used a third party professional management company. So I kind of started as an owner manager, with my own part-time staff, then full-time staff, then transitioning to professional third-party management with larger deals, which is what I do today, by the way.
Going back to the first 2 apartments, I mean, you really seem to have hit it out of the park with your first 2 deals. I think you said you were making about $10,000 a month at your corporate job.
That's correct.
And then with the first 32 unit, you were making about $4,000 a month in cash flow?
Yeah, between 3,000 to 4,000, and when I say between 3 to 4, when I first bought it, it was probably closer to 3. But then I owned that property for 3.5 years, where we, continued to push rents and raise occupancy and raise rents over that time period. So we went from, probably closer to $3,000 a month when we bought it to closer to $4,000 a month when I sold it.
And then with the second acquisition, how much were you making in a month off of that?
Well, that was about another, $2,500 to $3,500 a month. And again, the $2,500 was closer to when I bought it, and the $3,500 was more where I was at when I sold it. And that property was even more of a home run because, when I exited these deals, I exited property number 2 only after 2 years. I didn't want to sell it because, my goal was to get to $10,000 a month so I could quit my job. But what started happening is I started getting unsolicited offers to sell property number 2. And I'm thinking, no, I don't want to sell because then I'll never hit 10,000. Because in that moment, my goal was to get $10,000 a month so I could quit my job. But what happened, like I said, I got these unsolicited offers. I bought the property for like $500,000, property number 2 for like just over $500,000, and I sold it for almost $900,000 in like 2 years. And so, that kind of disturbed my economies of scale because I had these 2 properties, 62 unit total. And after I sold the first 30 units, now I'm carrying, a full-time manager, a full-time maintenance person for only 32 units. So that encouraged me to sell the 32 unit property as well. And I bought that for just under $1 million and sold it for almost 1.5. So, what I tell people is in 3.5 years, not only was I making some great cash on cash returns, but I bought and sold these 2 properties and made over $1 million capital gain in 3.5 years. And that's when I went and actually quit my job I thought, hey, if I could make $1 million profit in 3.5 years and essentially, at that time, double my net worth, I could just keep doing this, and go bigger and bigger. And that's what I've done ever since, I quit my job in 2005 and I've just been doing that ever since.
Such a great start for you. And then your third acquisition then was a syndication, 250 units, you said?
Yeah, 251, I think, is the exact number. And that's correct. It was also in the Houston area. It was a syndication. And I was able to I put in $200,000 of my own money, which largely came from the profit of selling my first 2 deals. But then I raised $1.8 million from other people, and we went out and purchased that property in a syndication model.
Up to that point, you had used your own money to purchase your first 2 acquisitions. What made you make that leap to being willing to raise money from other people to buy a larger property?
Well, there's so many reasons, and I could just, I'm going to touch on these a lot when I'm there in Grand Rapids, and that's part of, what I'm going to talk about as far as why I love apartment investing. But, you actually have better economies of scale with like a 200 unit building than you do with a 30 unit building. You get better financing. I was able to secure non-recourse financing with no personal liability. Does that sound interesting? That's very interesting to me. And now, every deal I've done since then, since those first 2 smaller properties where I had recourse loans that were non-recourse.
And by the way, recourse versus non-recourse for our listeners who aren't sure what that means. Recourse is if you get a loan and it's a full recourse loan, if things go bad, the bank can come after you for all the money that you owe them. Non-recourse, the bank can come after the property, but they won't come after you personally.
Yeah, so that's kind of a progression that I teach my students is, when you start with smaller deals, you're most likely going to get recourse loans. But now I have students that are even skipping that step. So, they're starting with, 60, 80, 100 unit buildings, syndicating, and they're able to put together purchasing groups that are able to qualify for non-recourse loans out of the gate, which is really cool. So, you could control more units, you can get better property management. Again, you could buy a 30 unit building and hire a professional management company, but they're going to take 6 to 10% of the gross monthly collections. So again, you don't have great economies of scale to do that. But if you buy a 200 unit building, you're probably going to pay, 2.5 to 3% of the gross collections. So again, you're getting, a better company with a lower percentage of your income going to property management. And as a deal sponsor, and I haven't talked about the money yet, but when you sponsor a deal, and being a sponsor is the person who leads the syndication, they're the person that finds the deals and analyzes the deals and secures the financing and then oversees the management company and is ultimately like the managing member of the entity that owns that property. And that person, because they're doing all the work and taking on more risk and putting in more time, they're able to take additional ownership interest in the entity above and beyond their capital contribution. So there's a lot of reasons why I like syndicating, and obviously one of them is we're leveraging our capital investment and taking additional membership interest in these deals. So if you want to go bigger faster, and also make more money faster, then syndication is something that you might be interested in doing.
Yeah, and having been the sponsor of 3 syndication deals myself, I can certainly attest to that. It definitely allows you to get a lot bigger, a lot faster. I'd like to talk about the why of getting into multifamily and apartment, kind of take it back a little bit and get into why. But I'd like to put it in context of something that you brought up twice, I think it has to do with Rich Dad, Poor Dad, and it's the ESBI, which I'm assuming is the 4 quadrants in the Rich Dad, Poor Dad. Can you talk about that a little bit?
Yeah, well, and I will, and just going into the why. I mean, for me, the why was, to be quite honest, I didn't like my job. I didn't like engineering when I was studying it, but I didn't want to change my major. And I'm thinking, hey, I'm just going to finish my degree and get a job. And then when I got a job, I was like, well, how do I change jobs without taking a pay cut? Because engineers tend to start at higher salaries than other fields of study. And, and I just went this way for years and years and years, job hopping, getting more degrees, switching jobs, getting laid off, going through the frustration, the anxiety. And so the why for me was very powerful. And it was, I need to replace my income so that I could, get out of that corporate rat race. And the type of people that I attract to my training tend to be people like me when I was, before I started. They tend to be, people with good jobs and degrees, and they have a little bit of money to invest. I don't teach a no job, no money, no credit, no problem type of approach. And so for me, that was my why. And then reading Rich Dad, it was like, oh my God, there was, all I had been taught by my parents and my professors was to get a great job. And at one point I wanted to move up the ladder in corporate America and be an executive of a Fortune 500 company. But again, after 2 degrees and 17 years, I just wasn't getting there. And so I knew that I needed to do something else. And, my only regret is that I didn't start sooner, and I didn't learn ESBI sooner, because that's what really put me on the track to become a business owner and an apartment investor.
Let's talk about what ESBI stands for. So you were in your corporate positions, you were the E in the ESBI, which is an employee.
Yeah.
As an employee, you're making W-2 income.
Yeah, so we got ESBI, and on the left side in the upper left quadrant is E, and again, that's an employee. So most corporate people are employees, and obviously you could be a very highly paid employee, but that's the small few people that make it to the C level in corporate America. And most people like me and the friends that I had, we were kind of in that middle, management, making, high 5 figures, low 6-figure type of income, but we didn't have additional income. We didn't have freedom. We didn't have security. We were all being laid off. We from time to time, or, getting acquired or downsized or whatever. So, when you're an E, you're really trading time for money, and you're not really, I hate to say, you're not really free. I had to ask my boss for vacation. I was told I couldn't take vacation. On one of my jobs, when I had a sales position and I was behind in my quota, I wasn't able to take vacation at the end of the year because I was behind in my quota. And it's like, so I felt like I was, being, held hostage to my job and being treated like a child. And, I was a 30-something-year-old man, and I wasn't allowed to take vacation. So that was my experience being in that E category.
Let's take a little break here so I can tell you a little bit more about our 2017 Michigan Landlord and Real Estate Investor Conference, February 23rd, 24th, and 25th of 2017, right here in Grand Rapids at DeVos Place. And registration is free if you go to rpoaonline.org. And here's what you're going to get. 7 national speakers. Robin Thompson talking about buy and hold and rehabbing investment strategies. Tony Youngs talking about hidden market strategies in today's current market. Tom Zeeb talking about his rapid cash generation blueprint, how to quickly make money without money in real estate. Sue Huyuela, vacation rentals, Airbnb, the secret to doubling your rental income without tenants using Airbnb. Vina Jones-Cox, the fastest and easiest way to wholesale properties for big money. Brad Sumrok, talking about earning double-digit returns and retiring early by investing in apartment fortunes. And Mr. Landlord, Jeffrey Taylor himself, talking about his new Take Total Control program. And we have some excellent breakout sessions as well. We have our annual economic forecast, as well as Grand Rapids future development. Other breakout sessions include real estate investment and asset protection, our very popular Don't Do What I Did and Idea Minute breakout sessions. Come to the deal room at lunch. This is where deals get done. We have a special panel on house hacking, marketing and screening for tenants, prizes and giveaways that you don't want to miss. Registration is free. Go to rpoaonline.org to register and secure your seat right now. And then just to go over the other ESBI, the S would be self-employed or like an independent contractor. B is business, owning a business. And I would be investor.
Yeah, and a lot of E's aspire to be S's, and to me, an S is just, again, ask yourself this: if you walk away from your business, are you still making money? And if you're an S, and a lot of S's are people like doctors or accountants, and people that, CPAs, people that own their own practice, or, even, rental property owners that might have, 5 or 10 houses that are actually doing the management and the maintenance themselves. I know a lot of single family wholesalers and flippers that are now apartment investors, and they were also in that S category. And they were like, hey, I'm doing fine. I flip a bunch of houses, but if I take a 2-week cruise or take my wife on a vacation for our wedding anniversary, I have no money coming in. And so that's an example of an S as well. If you walk away from your job or your business, do you still make money? And if the answer is no, then you're probably an S. Okay. Now a B is a business owner, and an I is an investor. And, Kiyosaki teaches that business owners and investors, generally they have their money working for them, and they leveraging other people, working for them. And generally, we start paying less taxes because we have, tax advantages to being business owners and investors. And so it's a more leverageable, side of the cash flow quadrant. And, when I first bought my first apartment building, I had to do a little bit, and I had to oversee the manager, and I went to the property, once or twice a month and taught myself QuickBooks and stuff like that. But I would sit at my job every day, and my manager would collect the rent, and my maintenance guy would do all the maintenance and repairs. And, with very little effort, and I'm not going to say zero effort, so it's not 100% passive income, but I would call it leveraged income. With a little effort, I made, like I said, $3,000 to $4,000 a month. And that's the first time I really experienced being a business owner.
Yeah, not to mention the tax benefits of being in the B and I quadrant.
That's right, because now, with that 32-unit building, I have income and expenses related to running that property, and I had positive cash flow to say, just say $40,000 a year. But now I get to depreciate the building. And so for $1 million building, you could depreciate it over 27 and a half years, which is about, ironically, $30,000 to $40,000 a year in depreciation expense. So I would be making $40,000 in cash flow, but after my depreciation expense, it would show that I, didn't make any money. So I wouldn't pay any tax on that cash flow. So that's another amazing benefit that you could have as an apartment investor.
Absolutely. So at what point, Brad, did you decide, okay, I've done the syndication thing. I've had a lot of great success in multifamily and apartments. I'd like to start training other people on how to do this.
Well, I quit my job right at the end of 2005. I was 38 years old, and I thought, hey, this is great. I'm going to keep doing apartment investing for the rest of my life because it worked and I made $1 million, and I'll just keep doing it, which I have done. But I also realized that, being an apartment investor, for me, it was never a full-time job. I learned how to invest in apartments part-time, and I was working in the corporate job for 3 years while I was an apartment investor. So, I've always learned how to do this in just, 5 to 10 hours a week. So then it's like, okay, I went on vacation. I actually went to Mexico for 6 weeks. And then I thought, well, now what am I going to do with my life? And I would get calls, and I would have people asking me to help them analyze deals. I had a mentor that helped me get started, and he asked me if I wanted to, help him with his program. And I loved helping people because I'll never forget the day that I was able to walk away from a 6-figure income. And so for me, and to this day, this is what I do is I love helping people get into successful deals, whether as a passive investor or as a deal sponsor. And so that's something that I'm really passionate about.
Talk about the difference between those two, between whether you're a passive investor or a deal sponsor. What are the roles that you take on with those?
Yeah, well, okay. So when there's a syndication, a syndication is a fancy word for, getting a group of people together and pooling your money together and buying a business. And you can buy, any type of business. But in the apartment world, we're pooling money together from people we know and buying apartment buildings. And so again, usually, out of a group of, let's say we have 10 people that are putting our money together, one of those persons might be the deal sponsor. And that person is going to be the one that's kind of actively rolling up their sleeves and finding and underwriting deals and securing the financing, managing the management company. And like I said, so they're going to put in some capital, but they're going to take an additional membership interest in the LLC that owns that property. And that's how I structure my deals with LLCs, by the way. And then the other 9 are going to be passive investors. And so these are the people that are also going to contribute capital. They're not lending, they are equity investors. And that's something that I wanted to clarify, because sometimes people think the passive investors are lending money, and they're not lending money in the way that I do it. They are actually putting in an equity investment. So they have ownership interest or membership interest in this LLC that owns a property. But as a passive, you're doing virtually next to nothing. I mean, you don't have to manage a management company. You don't have to find the deals. You don't have to analyze the deals. And the way we do our syndications is and this is a little bit more advanced stuff, but I'll just mention it here, and I'll talk about it a little bit at the conference on February 25th when I'm speaking. But we do 506B syndications, which require the passive investors to either be accredited, or they could be non-accredited but sophisticated investors. And sophisticated is a general term that just means they understand the nature of the investment and how the investment could potentially make money and how it could also potentially not make money. And so that's what is required of being a passive investor is either being accredited or sophisticated. And after that, there's not really a whole lot to do except sit back and get your financial reports every month. And when the deals are performing well, which most of them do, that I've done myself and that my students are doing, you sit back and get your checks every month or every quarter.
Can you tell us a little bit about your students and maybe share some success stories that you've had with them?
Sure. I get asked this all the time, and I've been asked this for 14 years as an investor and as a mentor, is that, Brad, is now a good time, and there's still good deals out there. So in 2016, from January 1st to December 31st, my students bought 29 apartment buildings in 11 different markets in the United States. So, we're buying in places like Dallas, San Antonio, Phoenix, Albuquerque, Florida, Ohio, Georgia, I personally own in 6 different markets. Okay. So we're buying in a lot of different markets across the United States. So 29 deals, 11 US markets, almost 3,000 doors my students purchased. Okay. And if you add up the purchase price of all of these 29 deals, it was like $133 million. And they raised $42 million of private equity from other investors. So, I teach my students what it is that I do. So I don't just, talk the talk. And some people say, oh, those that don't, do teach. And so I buy deals. I bought 981 units myself that I syndicated in 2016 and personally raised $22 million. And my students bought, 3,000 doors in 2016 and personally raised $42 million. The smallest deal they purchased was 14 units. The largest was 334 units. The average size is right around 100 units. And that's what they did just in 2016. Typical results. I mean, there are no typical results, but, I would say that what we strive for are double-digit average annualized returns. And so there's going to be a cash-on-cash component of the return, and there should be a capital event, which would be a sale or a refinance that we project is going to happen within 3 to 5 years. And so generally speaking, passive investors are generally doubling their money in 5 years. And that's happening in about, over my 14 or 15 year track record with my own deals and with my students' deals, about 80% of these deals are hitting that double your money in 5 years or less threshold. So I've come up with a recipe for that. What is the recipe to consistently earn double-digit average annualized returns? I'm going to share that on February 25th about where to buy and where not to buy and what to buy and what not to buy and all that type of stuff.
Now, is it the passive investor who's doubling their money in 5 years, or is it your students who are putting together the deals themselves who are doubling their money?
It's the passive. So when we do a 5-year projection, the projection, and this is above and beyond any sponsor compensation, is the passive investor should be able to double their money in about 5 years. I mean, and sometimes it could be 6 to 7, and sometimes it could be 3 to 4. But I mean, there's like this 5-year target for passive investors to double their money. So our experience is if we could buy a deal and offer investors the opportunity to, double your money or come pretty close to doubling your money in 5 years, we are able to have a great success and go out and raising private equity and attracting those types of investors. I mean, who wouldn't invest, if they had a strong degree of confidence that somebody could invest in a deal and make, nearly double their money in 5 years, and where 50,000 turns into 100 in 5 years, where you're passive and doing next to nothing. I mean, that's a pretty good opportunity for most people out there, and for me as well. I mean, I invest passively with some of the students that I train because they find deals and it looks like a good deal, and I'll put my money in some of these deals.
So to put that in context, if a passive investor invested, say, $100,000, if you sell the property within 5 years or at that 5-year period, that passive investor would get their $100,000 back out, and their profit between cash flow, profit at sale, principal pay down would be an additional $100,000.
That's correct. So yeah, that 100 would be a combination of cash flow and sales proceeds or refinance proceeds.
Or to break that down, you're looking at roughly a 20% annualized return per year over the period that you hold the property.
You got it. That's exactly what we teach and preach, and for the most part are able to obtain. And people ask all the question, well, Brad, what's the worst deal? What's the best deal? I mean, I've done a bunch of deals, 18 or 19 deals in all these years, and I've had a deal that, worst deal probably returned only about 6%. The best deal was like 89%. So it runs the gamut, but the expected return is around that 20% average annualized return. And like I said, about 80% of the deals that I've done, and now that I'm able to transfer that information to students, and they're having similar results.
I can kind of echo that myself just in the deals that I do. We just closed out a syndication and our annualized return was just over 19% per year.
Well, there you go. So, I'm not making this stuff, I'm not making it up,
That's what I'm saying. It is doable. And I think it's impressive that you and your students are out there buying now. What's your feeling about the market going into 2017?
Well, we're doing what I'm doing, and what I'm advising my students to do is, proceed with caution. And there's still good deals out there. And here's what I tell people: if you're on the outside of this business looking in, people have been saying for 15 years. Well, like I said, I get the same questions: is now a good time? So I would say, hey, look, don't try timing the market, because you never know when the market's going to peak or valley. I mean, when I was buying in 2009 and 2010, people thought I was crazy because the economy was in the gutter. And it's like, what are you doing buying these properties? And it's like, I mean, I made more money then than ever. But, I was buying, and from 02 to 08 in an up market, I bought and owned properties in a recession and a down market. And now we've been in an up market again for the last 6 or 7 years. And so, I understand how to underwrite deals, which is a fancy way for, doing your financial modeling. And I know how to underwrite deals to make them a bit more recession proof. Although, look, I tell everybody this, and I want to tell everybody listening to the show, there is no guaranteed rate or return. There's always a chance that you could potentially lose your money. And but from an underwriting standpoint, we want to make sure that we're using historical data. We're not using the rent growths that are occurring right now or last year and forecasting that 5 years going forward, because any deal would look great if you did that. So we use historical cap rates, historical occupancy rates, historical, numbers to do our underwriting. And that strategy has served me well, over the long term. And then it's also, it's a business where, it's like, in your neck of the woods, like let's say in Grand Rapids, there's probably, a few brokers that control 90% of the inventory. And, and this is not meant to, I just say it's a good old boy network, but hopefully people know what I'm saying by that. You don't have to be a boy or a man, but, the point is you got to be connected with people in the industry. If you just try to do this on your own as an outsider, it's more challenging. And so the people that, and how do you get started as an outsider is you work with people that are on the inside. And so having, people, you're borrowing other people's credibility. You can borrow other people's resumes. You work with proven lenders and attorneys that people know in the industry. And that's how you're going to get into the business. So there are still good deals, but a lot of the deals that are being marketed, don't work. Okay. And you might have to look at a lot of deals before you find one that works. And people ask me, well, what's a rule of thumb for that? And it's like, I had a student that analyzed 3 deals and the third one worked and he made an offer and he ended up buying it. But I have other students that might look at 40 or 50 deals before one pencils out. So, I think just, committing to, this is a retire in 5 years type of business, not 5 weeks or 5 days or even 5 months. So if multifamily investing is something that people are interested in, I say, hey, do this for the long term, acquire a skill set, and treat this as an investment in your future and not as a get rich quick type of opportunity. Because when you're learning the skill sets, mastering the skill sets, learning how to underwrite the deals and building those relationships with people in the industry, you will get deal flow and you will get deals that pencil out from time to time. I guarantee it. It happens with the students in my program all over the country.
Your topic at the conference is how to earn double-digit returns and retire early by investing in apartment fortunes. For those who are coming to the conference, which, by the way, is this month or this week, by the time this airs, Saturday, February 25th in Grand Rapids, Michigan, what can people expect when they come to hear you speak?
Well, I'm going to talk about the benefits of apartment investing, like I talked a little bit about here, but I obviously have more time there at the conference. So I'm going to talk about syndications. I'm going to talk about how apartments are valued with NOI cap rate and value. I'm going to show some examples with numbers. So, people like me that, with college degrees, we want to see the numbers. So I'm going to show some numbers and show an example of how you buy a deal for $1 million and raise the value to 1.3, and with a $300,000 down payment, and how that $300,000 down payment turns into doubling your money. I'm going to talk about the financing that's available. I'm going to share my proven recipe to earn double-digit returns. I'm going to summarize where I think the best markets are for 2017, where to invest, where not to invest, what makes a good market. And so these are all the things that I'm going to talk about. And I think I have about 90 minutes or 2 hours or something like that. And, those are the things I'm going to share. So people are going to get content. They're going to get, by attending my presentation, they should have, at the end of that presentation, they should have a very clear objective, which is, do I want to be an apartment investor and take the next step, or maybe this isn't for me? And so that's my goal, is to enable people to get enough information about how the business works to really say, yeah, I really want to do this. And, how do I get more information? Or, I'm going to do some other type of real estate investing. And I think having clarity is important, because the worst place to be is just being on the fence and just not knowing what you should do.
Absolutely. And it sounds like you'll be sharing some actionable material and content to help people really make that decision.
That's correct. And in fact, we didn't talk about this, Brian, but I did a webinar January 31st where I did a 2017 apartment investment forecast nationally. And if I'm allowed to say this, people that come into my breakout session, you'll be able to get access to that webinar as well.
That sounds very valuable. I'd love to hear that myself. So, Brad, you're going to be speaking this Saturday, February 25th of 2017. The conference is Thursday, Friday, and Saturday here in Grand Rapids, Michigan. You can register for free. I don't know how you can beat this deal. You can register for free at rpoaonline.org. And you get to hear Brad speak along with 6 other national speakers. I think it's going to be a fantastic 3 days. I'm really looking forward to hearing you speak, Brad. And I want to thank you so much for taking the time to talk with us today.
Hey, Brian, it's been fun. I'm looking forward to being there at RPOA, and looking forward to seeing all the people there.
You've been listening to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owner Association. You can find out more at rpoaonline.org. If you enjoyed this podcast, please go to iTunes to subscribe, rate, and review.